Welcome to Mad Money. Welcome to Cramerica. Other people make friends. Hey, I'm just trying to make you a little money. My job is not to entertain. I'm educating you. I'm teaching you. I'm doing everything tonight. So call me at 1-800-743-CBC. Tweet me, Jim Cramer. All right, we got something amazing today. A non-farm payroll report that showed some accelerated job growth, but also downward revisions in the last 2 months, therefore gave us a soft read, one that gives the Federal Reserve a lot more leeway for a rate cut. I know President Trump sure once when the market exploded higher from the get-go, and it didn't falter. That was in part because of the Just Right labor report, in part because the president didn't hurt his cause by tearing into our trading partners. In the end, the Dow gained 443 points, S&P climbed 1.03%, and the Nasdaq jumped 1.20%. Hey, what's on tap for next week's game plan? You've probably asked. Well, I've got it right here, okay? Let's go there. First of all, the week starts off with a meeting, and we don't know what's going to happen. A meeting with the Chinese to try to hammer out some sort of trade deal, or at least start getting us talking a little more. We have no idea where the two sides are, but we know this. The Chinese have something we need, rare earth materials, essential for the auto industry. And, well, we've got something that they need, okay? Now, without these rare earth materials, what's going to happen is our auto factories are going to have to shut down soon. At the same time, the Chinese desperately want NVIDIA's better semiconductors. Can a deal be made? Is that an even trade? Secretary Bessent will be part of the talk, so I'm actually optimistic something can get done because he ain't a bomb thrower. Apple stock just had a second straight positive week. That's an unusual occurrence of late. And some of the newfound luster might be in anticipation of Monday's Worldwide Developers Conference. Now, there's a lot of ballyhoo talk about this, but remember, this is a software event, not a hardware event, so they're not going to unveil new hardware, and it's usually not a catalyst for the stock to move, but it's obvious from today's aggressive buying that some speculators think this time is different. It's been hard to own Apple of late, whether because it doesn't have a top-notch AI offering or because it's been targeted by the White House for shifting some of its Chinese manufacturing over to India. The president wants the iPhone to be built in the USA, but it's not economically feasible. It's cheaper for Apple to just pay the tariff. The contentious relationship with Trump doesn't help at all. But maybe Apple can catch a break now that Elon Musk is drawing so much fire. That's my view that it's contentious. From the outside, some might actually think it's convivial. I just don't get that feeling. Also on Tuesday, Capital One speaking at a Morgan Stanley conference, which will be the first time it's told the story of its merger with Discover Financial, which I think will be huge. And that's why we have a nice-sized position in this one for the Travel Trust, which you can follow by joining the CNBC Investing Club. I think the synergies here are fabulous. And Richard Fairbank, the CEO of Capital One, understands credit cards as well as anyone on earth. It should be a very good meeting. Maybe that's why the stock was up $6 today, in anticipation of Fairbank telling a great story. Now, James Smucker reports Tuesday before the bell. Now, I don't know if it can escape the packaged foods purgatory that everyone seems to be involved in. This group acts the way that the coal stocks did not that long ago. Wow, what a compare. Smucker makes jams and peanut butter, so far okay, right? But its most exciting offerings are the Uncrustables, which are fantastic sellers. Now, I wish I could pound the table on this stock with its nearly 4% dividend yield, but the secular decline of the packaged food sector is just too powerful. And who knows whether the Secretary of Health and Human Services will go for the Uncrustable. We've also got a very important analyst meeting on Tuesday with Deere. The storied agricultural equipment company can tell a tremendous story about farmer orders. You know what? I think it can go higher still. I saw an upgrade today. After the close, we hear from GameStop, which is now going all crypto. While that's a lot better than being just a gaming retailer in secular decline, that's not saying much. So you'll see the gaming stuff, and then you'll see the crypto stuff. And the crypto stuff is what's going to drive this stock higher, probably. Now, we got a very popular IPO this week. It's called Circle Internet Group, which is a crypto platform, and buyers went crazy for it. So crazy that it's gotten people buzzing about crypto outfits coming public that might otherwise not have bothered. And maybe that's what GameStop can tap into. Look, I'm not a buyer of this. I'm just pointing out the storyline. Wednesday morning, we should have a report about what Jensen Huang, the CEO of NVIDIA, said at the GTC conference, this time in Paris. When I spoke with Jensen not that long ago, he lamented that the federal government wouldn't allow his company to sell a huge amount of chips in China. Jensen said he has a solid relationship with the president and that the president has a plan. He made it sound like there could conceivably be a deal that would be incredibly impactful. So now we go back to this. What he's saying and what happens from this are probably the two most important things of the week. Now, also before the bell, we get the May Consumer Price Index reading. This is an important one because it could give us a good read on how hard the tariffs are hitting the consumer. We don't know yet. Jay Powell has adopted a wait-and-see approach to cutting interest rates. I think that's smart. He definitely won't act if the CPI spikes, so this is going to be a very important number. Now, two companies give us earnings of interest on Wednesday. For the bell, we hear from Chewy, the online pet food retailer, which offers a lot of accoutrements that pet owners love. It's been a real winner. By the way, the CEO called the bottom on our show. I thought it was pretty great. I think you can continue to win. After the close, it's Oracle's turn. The last quarter was poorly perceived and the stock got hammered. Now it's bounced almost all the way back. That's an astounding 50-point move, almost in a straight line, too. Oracle's gigantic data center build-out should start paying off soon. I think that they can show some very good revenue growth this quarter. Now, Thursday brings some analyst meetings that could move the needle. Cardinal Health, we've had them on a couple times, tells a terrific story about how it's much more than a drug middleman, and I am a believer. But the one that I'm most interested in is BlackRock. That's the largest money manager in the world. Larry Fink started it. My Charitable Trust owns shares in the stock, which is down more than 3% for the year. It has not worked out for me so far, but I am patient. Maybe BlackRock can tell a good story about assets gathered, further explain the top-notch technology they have. If the meeting is positive, I bet the stock goes positive for the year. Adobe reports after the close, and it looks like the stock could break that downtrend it's been experiencing for some time. I wish the competition weren't so fierce here, but it doesn't seem to be letting up. Adobe's an amazing company. It's helped so many people and small businesses bring out their creative selves. If you can get this stock for under 20 times earnings, that's a little bit lower than from here. That's close enough to where it is now, though. I think it actually might be worth it, but it would be a flyer, okay? Finally, on Friday, we get the latest University of Michigan consumer sentiment reading. After reading through the Dollar General conference call, which I thought was very downbeat about our country, although upbeat about Dollar General, I get the sense that the consumer's feeling pretty darn gloomy. Let's see if the stock market's run has impacted that direction. The answer is probably not. So here's the bottom line. We should be headed for a quiet week, but you know what? We got to stay close to Truth Social to see what's going on in the White House before we assess anything these days. Given what happened with the president and Elon Musk this week, you need to follow all the palace intrigue, even if you don't want to. Okay, why don't we start with William in New Jersey? William.
Hello, Jim. First-time caller.
Oh, great, William. Thank you. Thank you for calling. How can I help?
I'm in a bit of a penalty box. I took your advice early this week and jumped into Lululemon ahead of the earnings. And I'm down about
I thought that Lulu would do better. I was quite surprised. It was a bad conference call. It was a bad quarter. I am aghast to think that this could be as such a horrible situation. They had tariff problems. They had the wrong fashion. Everything went wrong for Calvin McDonald. And what can I say? I just don't think he's capable of being as bad as that stock was. 17 times earning. It was a bad quarter, though. And, William, I've thought a lot about this and a lot of soul searching. I am shocked at how they missed the quarter. And I wouldn't be surprised if there weren't some shakeups if that happened again. Now we're going to go to Jason in South Carolina. Jason.
Hey, Jim. Thanks for taking my call.
Of course.
All right. Question. Do you think Deere's done, or is there still more to go? Is it still a good time to buy?
No, Deere's good. Deere's good. Deere's in a great. The farmers are in great shape here, and I know that Deere looks like it should be peaking because it's had such a big run. Believe me, this stock has multi-year moves. I really still like Deere here. Let's go to Frank in New York. Frank.
Hello?
Frank, you're up. Yes, it's Jim. What's up, Frank?
Hey, Jim, thanks for taking my call.
Of course.
Thanks for your 20th anniversary, and I've been with you the whole 20 and before that, Kudlow, so I'm a Cramer lifer.
My. All right. You've got a lot of Cramer. You've got Cramer. How can I help?
Okay, listen. I own Uber. Everybody loves Uber. It's a free cash flow giant, okay?
Yes, it is.
This stock could be $100 and something, Jim.
I agree with you.
When are people... people are worried about autonomous driving. That's not going to hurt them. They're partners with people.
I agree with that, too, especially with the setback of Elon. Look, I got to tell you, I am so with you, Frank. You and I, we are so simpatico. Perhaps it's because we've been with each other maybe 25 years. I think your question and answer on Uber is yes, it goes higher. And I got to tell you, I think that those who doubt it, all right, next week could be a quiet one, but, we're going to have to keep an eye on what the White House says before we assess what's going on, particularly with China, obviously. On Mad Money tonight, is the travel bull market still with us? I'm digging into last night's results from Vail Resorts that sent the stock lower today on an up day. Then you called in, you stumped me on an under-the-radar aerospace and defense stock. I'll reveal the name, and I'll show you why I am very much intrigued by the story. And we're playing Am I Diversified to see if portfolios of Cramerica are ready to handle whatever the market throws at them. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Is the travel and leisure bull market still with us? Last night we got results from Vail Resorts, which owns 42 ski resorts in North America, Europe, and Australia. Well, this was basically an inline quarter. The market wasn't too thrilled, sending the stock down nearly 3% today on what amounted to a pretty good session. Now, I got a soft spot for Vail because they have a portfolio of some of the best ski resorts on Earth. It's impossible for a competitor to put something together like this. This thing always seems like it should be a great business. We know these places charge a fortune, right, with a captive audience of guests paying through the nose for lift passes, equipment rentals, ski lessons, lodging, food. For years and years, the stock was an incredible performer. From the financial crisis bottom in March of 2009 to its all-time high in late 2021, Vail rallied from just $15 to $376. That is nearly a 2,450% gain. But since then, the stock's come down hard. It's never really been able to find its footing. Now, some of that's not their fault. I mean, most growth stocks did very badly in 2022. The thing is, unlike the others, Vail hasn't bounced back over the past few years. In fact, they had a pretty darn disappointing 2023 to 2024 ski season. Oh, look, around this time last year, management was blaming that on, quote, unfavorable conditions, end quote, meaning a lack of snow in the Mountain West. Unfortunately, things got worse this past ski season. Last fall, it started to become clear that season pass sales were floundering. Now, that was in part because the company's been so aggressive with its price increases over the last few years. Then, during ski season, Vail had some high-profile operational issues, to put it lightly. For example, there was a nearly 2-week strike over ski patrol wages in Park City Mountain in Utah, leading to comically long lift lines during one of the busiest parts of the season, with outraged skiers chanting, "Pay your employees, pay your employees." In response, the stock got clobbered in the first few months of 2025. Sell, 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 sell. By the time Vail bottomed in the post-Liberation Day washout in April, the stock had fallen to about 130. That's the lowest level since the depths of COVID in March 2020. Around that time, when the stock was 145, we got a call about it here, and I said I was getting real interested given how much the stock had come down. Then last week, something happened that made me even more intrigued. Vail Resorts brought in new leadership, actually brought in old leadership. Last Tuesday, after the market closed, Vail announced that Kirsten Lynch, who'd served as CEO since the fall of 2021, would be stepping down to be replaced by a familiar face, Rob Katz, her predecessor, who ran the company from 2006 to 2021. Wow. All right. Basically, Katz served as CEO during the entirety of that halcyon period for Vail. The stock peaked less than 2 weeks after he left that role in late 2021. Hasn't been the same since. So investors were very bullish on this news. Sent the stock up 8% in response, although it's now given back all those gains because of the quarter Vail reported last night. And that makes sense to me. Speaking of the quarter, you knew it wasn't going to be great given that the CEO had just got ousted, right? I mean, it's kind of a tell. Sure enough, the 2024 to 2025 ski season ended pretty darn poorly, with a weak April. That said, even with a 3% decline in the number of skiers this season, Vail had some modest improvements in its financial results, with resort revenue up 3% year-to-date, driven by a 4% increase in season pass revenue. Even though the number of skiers was down, they raised prices by 8% ahead of the season, and the people who did come spent more money on ancillary services. As for the headline results, Vail posted in-line revenue with a 50-cent earnings beat off a $10.04 basis. Now, it could have been worse. Management tightened their full-year forecast, raising the low end of their earnings guidance and lowering the high end. But the midpoint ended up lower. The new guidance reflects the weak end of the ski season, which Vail said was partially mitigated by strong cost discipline. Of course, that's not the whole story. With the quarter, Vail gave its first update on season pass sales for the upcoming ski season. Pass product sales through May 27th decreased by roughly 1% in units, although in dollar terms they're up 2% year over year. Again, this is big. A big price increase is making up for slightly lower volume this season. And prices were raised another 7%. Oh, my. Now, the context is important here. These season passes went on sale within a week of Liberation Day and the ensuing stock market mini crash that followed. I'm betting some skiers just held off on buying a pass as that was happening because the more high-end ones can cost over $1,000. As the new old CEO Robert Katz put it, quote, given elevated levels of macroeconomic volatility that occurred throughout the spring selling period, it is currently unknown what, if any, impact that had on early pass decision-making. Still, analysts and investors seem disappointed by these initial numbers, which is the main reason why the stock just got clobbered today. Interestingly, though, maybe not all that surprising, given that Katz has remained as executive chairman of Vail Resorts this whole time, and he's only been back in the CEO role for a week or so, management didn't signal any major strategic shifts that were in the offing. That was disconcerting to me. So where do I come down on this stock after last week's leadership shakeup and last night's conference call? Long story short, I'm still finding this Vail Resorts intriguing down here, but it might take a little while to get the turn to happen. This remains a truly unique business, something that can't be replicated. And you're getting this opportunity to buy the stock at a fairly significant discount. And it's currently trading at less than 20 times this year's earnings estimates. By historical standards, that makes it pretty darn cheap. But man, it sure feels like Vail needs to do something to get its mojo back. Maybe they need to cut price or at least, very least, hold them steady. I like this idea. They put through high single-digit price increases for season pass every year for the past several years, which seems to me very aggressive, especially given the lack of unit sales growth here. Maybe they need to think about some strategic moves. Do they really need resorts in North America, Europe, and Australia? Do the regional ski resorts in places like Ohio and West Virginia, Pennsylvania belong with the same company that owns Vail and Whistler? You could argue that they really don't belong under the same roof. But the bottom line, I think Vail Resorts has potential here, even if I'm not willing to pound the table on this one. If you want to bet on a comeback, I think you put on a small position now in recognition of just how cheap the stock's gotten. But I'd like to see more of a turn in the business before truly sticking my neck out for Vail. And Mr. Katz, when you're ready, you're more than welcome to come right here on the show and tell us more about your plans to get the business back on track. Mad Money is back after the break.
Coming up, could a stealth aerospace and defense play be the right fit for your portfolio? Cramer is putting the name on your radar. Next.
Every now and then I get a call about a company that I either don't know or haven't been following regularly. So I promise to do the homework and come back to you with the full story. Tonight, I've cut not one, but two of them. Two stocks that I got on the same day, and I kind of screwed up. Just didn't know them. What can I say? I try to learn as many companies as I can. But Alex stumped me. Alex in Oregon. He asked about Esco Technologies. Now, this is the same Alex who asked about LeMaitre in April, another stock I didn't know. We used to call this game Stump the Chump, so I guess that makes him the reigning champion. Okay, this is a real good one. Esco Technologies used to be a part of Emerson Electric before it was spun off way back in 1990. Today, Esco Technologies makes highly engineered filtration and fluid control products, as well as integrated propulsion systems. Okay, the company's also an industry leader in radio frequency shielding and electromagnetic compatibility test products. They make diagnostic instruments, software, and services for the electric utility and renewable energy industries, as well as industrial power users. Now, okay, all right. Now, maybe that doesn't sound like the most exciting company in the world. But when you look under the hood, there's actually a lot of interesting stuff here, which is why the stock's up more than 70% over the last 12 months. See, over 40% of ESCO's business last year came from their aerospace and defense division, where they make specialized parts for airplanes, satellites, warships, and missile defense systems. They make hydraulic systems on aircraft. They help submarines stay off the radar. They even produce miniature explosive devices for missile launch systems. Same stuff fighter pilots use when they need to eject. In short, ESCO is an arms dealer to the defense contractors. In fact, 27% of their sales come from U.S. government contracts, which is either a strength or a weakness, depending upon how you look at it these days. More on that in a moment. Another 35% of ESCO's revenues come from their utility business, which helps power companies keep their systems running safely and efficiently, and that includes alternative energy. You know, these guys have a bat deterrent system, keeps the darn things from flying into windmills. Rounding out the business is ESCO's RF test and measurement segment. That's 20% of its revenues. Basically, they help a wide range of industries ensure that their electric components work properly. Again, not exciting, but this stuff is important, especially in the medical industry. If you're selling, say, pacemakers, you need to make sure they won't malfunction the moment that they get hit with a radio signal. There's a lot of government regulations surrounding stuff like this, so better to be safe than sorry. Honestly, you know what? This sounds like a well-rounded business. And when the company reported back in May, that was on full display. ESCO turned in slightly better than expected sales, up 7%, with truly better than expected earnings, up 24%. Management was confident enough in the momentum they're seeing to raise their full-year earnings forecast. That was good enough to send the stock rallying more than 6% the next day. Buy, buy, buy! Looking ahead, ESCO is focused on the businesses that it feels it has the most long-term promise in. Recently, the company completed its acquisition of Ultra Maritime's signature management and power business for $550 million. This business serves the American and British navies. ESCO wants to boost its exposure to submarine and shipbuilding business. These are great businesses. Now, some investors might be concerned about cuts to federal government spending, although DOGE seems to be on shakier ground than it was, say, 48 hours ago. Even when Musk was still there, they never really went after defense spending. ESCO is confident their particular areas of expertise are a high priority for the Pentagon, meaning they're unlikely to be hit by spending cuts, and that's assuming we get any meaningful cuts to the defense budget at all. With the president signing an executive order earlier this year to create the Maritime Action Plan aimed at revitalizing our maritime industry, otherwise known as Make Shipbuilding Great Again order, I wouldn't be too worried about anybody in the shipbuilding business. Overall, I find this one intriguing. Sure, with ESCO trading at roughly 26 times next year's earnings estimate, it's not the cheapest stock in the market, but this is a company that's looking at nearly 15% earnings growth next year, and 40% of the business is related to aerospace and defense, which is, I think, great shape here. Even though the stock doesn't garner a lot of Wall Street coverage, that might just be another positive. Not a bad idea to start a position before the analysts start getting enthusiastic about it. You can tell I like this company. It may seem like a boring business to some, but not everything needs to be a play on crypto or artificial intelligence or flying cars. Which brings me to our next homework name, DeFi Technologies, which was brought to my attention by Joe in Arkansas. DeFi, short, is a Canadian financial tech company that specializes in decentralized finance. DeFi, it's the name. This Toronto-based company offers investment exposure to digital assets like Bitcoin, Ethereum, and lesser-known cryptocurrencies. They make it easier for those who want to get into crypto, but don't want to deal with the digital wallets or any other sort of crypto infrastructure. These guys mainly operate through their subsidiary, Vail, where individuals can buy exchange-traded products in the crypto assets I just mentioned. Naturally, DeFi is a pretty speculative name, and that's putting it lightly. It's got a market capitalization of just over $1 billion. This one's barely big enough for me to even mention on air. On top of that, DeFi doesn't even have $1 billion in assets under management. Now, in management's defense, the company was profitable last quarter and doesn't have any meaningful debt. While DeFi currently offers roughly 65 exchange-traded products in the crypto space, they're continuing to bolster these offerings and expect to have 100 by year-end. But don't get too excited. These products are mainly for the Europeans at the moment. Entering the U.S. market doesn't seem such a high priority for them. However, they seem very excited about their new research unit, Reflexivity, which is Reflexivity Research, which they bought from Anthony Pompliano. You probably see him a lot of times on Squawk Box about a year ago. DeFi also operates an arbitrage trading desk that brought in $100 million last year. That's a nice windfall, but not exactly as reliable a business as ESCO Technologies. going back to the speculative nature of this stock, the company only became available for trading on the NASDAQ about a week before Joe in Arkansas asked me about it. No wonder I didn't know it. Since then, it's down about 18% despite a rally today. You haven't missed much. So let me give you the bottom line here. DeFi, D-E-F-I, Technologies is a pretty volatile name, and I'd much rather own something consistent like ESCO. As I've said many times, if you really want to invest in crypto, just buy actual crypto. All these other instruments tend to have more risk than I'm comfortable with. You don't need that in your portfolio. How about we go to Doug in California? Doug.
Hey, Jim, how you doing?
I am doing well, Doug. Tell me what's going on.
All right. My dad worked for a company that's been around for 160 years. It was called Babcock and Wilcox. Now it's BWXT Technologies.
Right.
And I just want your thoughts on that stock.
Okay, now the nuclear industry is on fire right now. Oklo's going crazy. You know, all of them are going up. I prefer GE Vernova, but I will say this: as I said last Monday, I will no longer say I would not buy that stock. I think this stock, BWX Technologies, is just one push away from going to 150. So that's the way I'm going to leave it. I'm not going to just say I'm not sneering at these stocks anymore. Charles in Florida. Charles.
Mr. Cramer.
Yes, Charles.
I've been a holder of Berkshire Hathaway since 2007. The first 90 days it fell 45%, but I held on. The only names I've ever heard are Warren Buffett and Charlie Munger.
Right.
Now Charlie is gone, and if I may add, Becky Quick of your station did an excellent interview, Charlie Munger, A Life of Wit and Wisdom.
Yes.
See it. Now Greg Abel is the heir apparent. The stock as of opening this morning was down over 8%.
Okay.
And the only print in the Wall Street Journal I've seen is who's going to run the insurance business. Can you please add something positive? Thank you.
All right, so Berkshire B. Look, I like it. I know that Warren's retiring. I get that. But you know what? He has a big bench. He has terrific people. And I know that we should all love and appreciate Warren, but I am also going to appreciate him for what I think is going to be a consistent way to have a new CEO, and that's how I'm going to leave it. All right, DeFi Technologies is a name that's a little too volatile right now, and I prefer to own something more consistent. That's why I say we should go with ESCO, E-S-C-O. Much more made money, including Cramer's, well, yes, it's our favorite game, Cramerica's MI Diversified. Then Tesla stock got pummeled today after Elon Musk took aim at the president yesterday. But with rebound today, what do you make of the action? And do we need to value Tesla differently now? I'll give you my take, plus all your calls, rapid fire, tonight's edition of the Lightning Round. So stay with Cramer. The major averages have gotten off to a pretty darn good start in June. But we know things can change rather quickly in this market. So you have to be prepared for whatever might come your way. And that's why tonight we're playing MI Diversified. What do? Well, you call me. You tell me your top 5 holdings. I tell you if your portfolio is diversified enough, maybe you need to mix it up a little. Tim in Ohio, you're our first caller. What do you got for me, Tim?
Hi, Jim. This is Tim from Columbus, Ohio.
All right. Go ahead.
Home of the Buckeyes.
Home of the Buckeyes? Man, well, you can't beat them. Well, actually, you can. But go ahead. What do you got?
The stocks that we have in mind are Disney, Abbott,
all right,
Amazon, Novo Nordisk, and Applied Materials.
Well, let me go to work on that group. Buckeyes, let's go, let's go, let's go. Abbott, Travel Trust name, that's medical devices, okay? Really excellent. Walt Disney sneaking up through the 113 level. We like that. Entertainment. Applied Materials recommended this very morning. Got a nice upgrade, but I prefer Lam Research. That's a capital equipment for semiconductors. Novo Nordisk, well, we're not Novo people. We're Eli Lilly people. And Amazon, well, how can you not beat it? I mean, Amazon's everything. It's retail, cloud service, cloud, web, tech. Retail, medical device, entertainment, semi-equipment, Lilly, drug. I'll tell you, Tim has got it. He's got it going. That's exactly what I'm looking for. But now we're going to go to where my daughter used to live for a long time. We're going to go out there, Oregon. We're going to speak to R in Oregon. R. Go ahead.
AR. It's AR in Portland. And Jim, a huge fan, first-time caller, long-time listener. I'm a member, and I want to let you know, I have a picture of God and you on the same wall, and I pray to you both. You sped up my retirement by 10 years, and I love you for that.
Well, thank you very much. Thank you. Actually, I've not heard that before. This may be the first time. I'm looking at my executive producer, Regina. That's a first, isn't it? Yeah, Regina said it's a first. She's been with me a long time.
But I love you like hell.
Thank you, man. Well, then why don't we go to work together? Let's see how we do.
All right. ServiceNow, Salesforce, Bristol Myers, Palo Alto, and Meta. I know, and of course, I made my money on NVIDIA thanks to you. I'm not telling you that, so let's just break this down.
All right, NVIDIA stuck here at 41.42. We got to see a breakout next week when Jensen goes to Paris for Paris GTC. All right, ServiceNow. Well, we love ServiceNow. Okay, ServiceNow is, we've got corporate software that also is AI. Okay, it's enterprise software with AI. Meta. Well, Mark and I are we don't talk that much, but we got a good social media there. Bristol Myers, Charitable Trust owns it. So far, we're not happy with Cobenfy. It's a little disappointing. We need to see that stock back up at 60. Apple, we've got that big developers conference on Friday. I am not going to raise the temperature. The thing is not a needle mover. We should stop saying it's a needle mover. We like Apple, though. And then Palo Alto has just become, after Zscaler, the cyber equipment company that people most want. Cyber, okay, social media, enterprise software, let's just call it, what do you want to call it? Well, why don't we call it an iPhone company, and then drugs. That, again, ours got it going. I mean, now ours a little effusive about my particular role in life, but you know what? You take it where you can get, is what my mom used to say. Next up, we're going to stay in my home state. We're going to go to Larry in New Jersey. Larry!
Hey, Jimmy, chill. Hope all is well with you.
I am chill today, my friend. I sensed it right up through my body to my head. I am chill. How can we work?
I'm sure you are. I've been following you back since the Jurassic era, Todd Harrison days, Minnie Anvil, going way back.
Oh, my God. Yeah. All right. Well, that was another era. What can I say? That was Paleozoic era. Yeah. So let's go to work.
All right. So 5 stocks I got 50% in the S&P 500, the SPY, and then here's my 5 holdings: Berkshire Hathaway B, Palantir, TJX, one of your charitable trust holdings, Tesla, and Walmart.
Wow. Okay, this is sensational. He's got my accent. Must be Southern Jersey. I think that's great. Tesla. Okay. Well, that's a thorn in the side of the president. I mean, I don't know. It doesn't really sound very good. This is more of it's now back to being a car company, because I don't think you can do those other things right now. Berkshire Hathaway, diversified conglomerate. TJX, just my favorite of the discounters, discount retail. Walmart is no. We're gonna have to do something there in a second. Palantir is going to $200. We're gonna have to get rid of one of these. We're gonna keep TJX because I really like the pricing TJX. We're gonna get rid of Walmart, and we're gonna put, because we need a drug company, Eli Lilly goes with diversification of that and an auto, and Larry's he's got it going, but he can't have both TJX and Walmart. They're too much alike. They trade together. It's just true. Hey, you know what? How was the last time we had a caller from Kentucky? Jerry in Kentucky. Jerry.
Oh, Jim, calling in today from my boat on Lake Cumberland. I'm
Fantastic.
a first long time. I've been a fan of the show for 20 years, club member, and you are the professor of stock investing. I appreciate everything you and your staff do for us. And being from Kentucky, you know what I want to hear after I ask you, am I diversified?
Well, look, if you're from Kentucky, you must be lucky. Let's hear the stocks.
Okay. We've got Costco, Palo Alto, Eli Lilly, Waste Management, and ISRG, Intuitive Search.
Excellent. All right. Wow, Kentucky. We got callers everywhere, and I just love it. I love it. Intuitive had such a great quarter. It was like killing me that I'd been known for the Charitable Trust. Medical equipment. Eli Lilly. What can I say? That's medicine. We like it. Costco, world's greatest retailer. Nothing on, no flies on that. Palo Alto, that's the Keshe, amazing company. Cybersecurity, Waste Management. Couldn't break through the 236 level today. I was quite surprised. I thought it would have done that. Okay, so we got waste. We got medical equipment. We've got, let's call it drug. We've got retail, and we've got cybersecurity. I mean, I don't know. Can it get better? Every single portfolio, someone's cheating. Someone has their finger on the scale. Those portfolios were all that good. The only overlap was that one gentleman that had Walmart and TJX. That was it. Otherwise, there was nothing to do. I didn't have to worry about Joby and Archer Aviation or Okla or any of that stuff. So I want to thank you for all your submissions. That money is back after the break.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time. It's time for the lightning round. Chris, goes on me saying this. I started by so it's better to know. Sound questions at time. I said, play this out. And then the lightning round is over. Are you ready, Steve? Daddy, time for the lightning round. Chris, let's start with Mark in Florida. Mark.
How you doing? Yes, sir, Mr. Cramer.
What's happening?
How you doing? So I've been looking at Omicron.
Yeah, I know it looks cheap, sir, but I've got to tell you that when I read what Mark Zuckerberg has to say, and look, he runs Meta, big company. He's talking about disintermediating ad firms, and I'm afraid that he's too powerful. I would not go against him. Let's go to Jim in New York. I'm talking to myself. Jim.
Hi, Jim. Booyah.
Booyah, Jim. What's up?
Thanks for taking my call.
I'm thrilled you called.
Yeah, and I'm a big fan of yours, and I want to say a special thanks for helping investors like myself.
Thank
you
you
so much.
We're trying to do that. I'm glad it's working. That makes me feel great. How can I help?
I've been a club member for about 4 years. Back when I first started, I acquired my position in Disney, where it was a cost basis of about 128. It never ever made any money for me. I'm just wondering, do I sell?
No. I think Disney's finally getting its feet right. I think that it had some management turnover. They're getting things. I like a lot of the things that Iger's doing now. I like Hugh Johnson. I want you to stay. If anything, I'd like you to buy more. Let's go. Remember, we don't care where a stock came from. We care where it's going to. I think it's going higher. Let's go to Jeff in California. Jeff.
Yes. James, how are you this evening?
You know what, Jeff? I am all fired up. I'm good. How about you?
Nice, thank you. Yes, Peloton. What do you think with all the?
Well, it is a subscription business, and I like subscription businesses. I think that they work, but I don't think they have the growth. So therefore, I'm going to say, if you want a subscription business, I want you to be in Spotify. I need to go to Angelo in Ohio. Angelo.
Cramer, booyah from Ohio. Thank you.
Yeah, we love Ohio here. We love it.
Yes, we love you. My family loves you. You've made us so much money. What do you think about Walmart, my friend?
All right, Walmart's been stuck at this level. Well, usually when that happens, it's gaining momentum. It'll burst through. I think gets to 110. Let's go to Bill in Massachusetts. Bill.
Hi, Jim. How are you today?
I am good, Bill. How about you? How you doing?
Good. I wanted your opinion on Reddit. Do you think
I'm so glad somebody called me on Reddit, because this thing is breaking out. It's going back up. It's up 9 today. I think that the quarter was much better than people realized. They were starting to cut some very big deals. They are integral to a lot of different of the chat bots that I look at. I think Reddit is a winner. Let's go to Dan in California. Dan.
Jimmy Chill. Booyah, buddy boy.
I be chilling this weekend, let me tell you something. I'm going to club some fish. Just kidding. I love fish. I throw them back. I'm a catch and release guy. About everything in life, I'm catch and release, frankly. All right, what's up?
You're a good man. You're a good one. Hey, before we start on my stock, I got fantastic news for you. Born and raised in San Diego, greatest Philadelphia Eagle, one of the greatest of all time, is entering the Hall of Fame this summer. Talking about number 21, Eric Allen.
Did you remember that run back that he had from the end zone? That was a 101-yard run back. What a pick!
I remember it.
I love him. But then again, I keep watching.
You need to go to the ceremony.
You're absolutely right. But look, I got to tell you, I keep watching Cooper DeJean. Every time I'm down, I watch that pick. Anyway, it's probably far afield. My executive producer saying, Jim, it's not a football show, it's a stock show. So let's do some work.
Eric's our hero in San Diego. Listen, buy, sell, or hold on Kindle Morgan.
Kinder Morgan's good. Kinder Morgan's good. The company got it together. Anything in the pipelines is working. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, from bromance to breakup, how the social spat between President Trump and Elon Musk could impact Tesla's share price. Cramer plays mediator. Next.
You know, I'm writing this book, How to Make Money in Any Market. No, it's not done. This is just a dummy with a cool cover. And one of the chapters, I talk about the Magnificent Seven and what I think will happen with each one of them. I've been very positive about Tesla. It was a pan to Tesla's fabulous cars, self-driving technology, robo-taxi, and most of all, their Optimus division is developing humanoid robots. I still believe in technology, but I just had to make a bunch of revisions thanks to Elon Musk's erratic behavior. Again, Tesla's self-driving cars show a sense of awareness that I think is vastly superior to Alphabet's Waymo. Their unique self-driving capability is backed up by an NVIDIA-powered neural network that I feel is best of breed. The technology is based on visual perception. I've driven in a Waymo, which has more reliance on a mapping and radar system, and it worked fine. But I trust the system based on visuals. Tesla's plans for robots are expansive and aggressive. Mustangs will all want robots. They'll be essential. If he's right, the Optimus division could be worth the entire amount of the company. I initially gave it a very high grade because I wanted to be a Tesla shareholder one day for the charitable trust, having liked the company for ages, although I could never bring myself to pull the trigger. Last night I went back and I changed the grade I gave Tesla. It's lower, but it may not be low enough because the world changed for Tesla and all of Musk's myriad businesses the moment he broke with Trump. Those who act like nothing's changed, including the analysts who love the stock before the contretemps, as though a spat with the President of the United States is merely a speed bump, they're out of their minds. It was one thing when Musk was just opposing Trump's agenda. That's just business. But yesterday, Musk got real personal. I don't even want to bring up the allegations because, frankly, they're just too incendiary. And as you may have noticed, President Trump is not a super forgiving guy. We have seen that he's willing to seemingly stop at nothing when it comes to retribution, which brings me back to Musk. Putting the substance aside, if I were in Elon Musk's shoes, I would not pick a fight with the President of the United States, and not just because he spent $250 million helping Trump get elected. The Washington Post and the New York Times have detailed all the ways in which Musk's various enterprises dovetail with the federal government. But you know what? I don't care about Starlink or SpaceX. What I care about is Tesla. And man, if anything goes wrong with Tesla's self-driving technology, I could easily see this president issuing an executive order to ban them from the road. Just one accident is all it takes, and there will definitely be accidents, even if self-driving cars are safer, maybe much safer than human-driven cars. Back when Musk was on good terms with the White House, I had hoped that Tesla's self-driving cars would be granted approval to drive on the interstate highway system. Said that many times on the show. I'm now putting that in the highly unlikely camp. Robots, again, there are a million reasons that the president could use to ban them too. So we now have to go back and value Tesla like the car company it is, not the technology company it could have become. If that's the case, then frankly it's fairly valued, maybe even overvalued, as Tesla's cars are not selling well and the federal government will no longer subsidize their purchase. While I have faith in Musk to design and execute better than just about anybody in the world, I have to be realistic. He's a brilliant businessman, but a downright self-destructive political operator. Musk has created a world of hurt for his shareholders. He's become toxic, which means that Tesla stock has become too hard to own. It's difficult to own any stock these days, but one that's in the crosshairs of a vindictive president? No, thank you. I like to say there's always a bull market somewhere, and I promise to defend it just for you, right here on Bad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.